Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's October 9th. I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. You know, we live in a pretty crazy world where the opinion of a complete nobody can result in an entire country banning the NBA. Come on, guys, you know I was going to go there. Two topics, China and NBA basketball. That's what I love to talk about. You knew I was going to come out with this intro. Strong opinions about it. Knew I was going to go there since it is a top story on you can look at every site. I mean, financial site, you look at every major sports site. Talk about the NBA in China. And if you live on another planet, which is perfectly fine since the story's everywhere now, let me break down what's going on. So the general manager of the Houston Rockets, right? So the general manager is only really an important position or maybe notable position in baseball. Other than that, it's kind of like a director at a company, right? Like you never know who the directors are in the company. You have to look them up, right? So the general manager of the Houston Rockets, his name is Daryl Morey, sent out a tweet last week with an image saying, "Fight for freedom, stand for Hong Kong." So the tweet is about the pro-democracy protest taking place in China, which is now turning a little violent based on what we see in the stories and stuff like that, several reports. But it has been crazy enough to where they've closed railways, shopping centers, supermarket stores, banks. I mean, they're closing almost everything. And it's getting a little crazy down there. Now, Daryl Morey, and I'm not saying this in a bad way. I'm really not. But he's a complete nobody in terms of being an influential figure in America, right? So most people in the NBA, outside the Houston Rockets, don't even know who this guy is. Again, I'm not putting him down. I'm really not. But this is not LeBron James tweeting. It's not Zion Williamson. If you're not familiar with Zion Williamson, he's like the next LeBron James. Very, very, playing his first year. Kevin Durant, Magic Johnson, Michael Jordan. You don't have one of these huge influential people making this statement, right? These are all influential figures in the NBA. This is coming from a complete no-name person. So after this tweet, China officials got really pissed off at the NBA, where one network said, "Chinese Rockets fans are first Chinese. We love Chinese red more than Rockets red. And the Houston Rockets really fouled. If you foul, you have to pay the price," right? So I'm quoting. And by the way, you look at Yao Ming, who was a huge part of the NBA's aggressive marketing push, right? Pushing its brand to China. He actually played for the Houston Rockets. Talk about the same team here. So the Houston Rockets are kind of considered like the Yankees or the Cowboys in America, one of the country's most loved teams. And since 2017, it even gets a little crazier, where Yao Ming is a chairman of the Chinese Basketball Association, right? So a few things here, which I want to cover. First, how can a tweet from an absolute nobody? I mean, Daryl Morey has only 1,700 people on Twitter following him. Yes, I did check. So it was probably 500 less before he sent out this tweet. But how can one tweet from basically a no-name person influence one of the biggest countries in the world, which is China, and a multi-billion-dollar sports brand in the NBA? Because this is one person's opinion. Again, it's not LeBron, Jordan, Magic tweeting this to the tens of millions of followers on Twitter. I mean, how sensitive have we become? Like, what is going on? How did this turn so bad so quickly? And you can say, well, there's a lot going on between China, U.S., and Trump and trade negotiations. So this is just, something that's going to get amplified even more. Whatever, but it's a tweet from a no-name. You think about that, how crazy it is, how everyone's so sensitive these days. And with that said, listen, I think China has every right to be pissed off, but not to ban the NBA. I mean, a fun, peaceful sport so many people enjoy watching. Yes, we have free speech in America, which gives every idiot a platform to say whatever the hell they want. And I guess you could say, Frank, you know what? You're one of those idiots, and you're doing that right now. You'd be correct. But how about this? How about we try to avoid getting in everyone else's business? I mean, there's so much shit wrong with America right now. So how about we fix our own problems first before trying to tell every other country around the world how to fix theirs? and how great America, oh, we should do this, you should do that. It's different cultures. And this tweet, I truly believe this, was not meant to criticize China as a whole. So I can see why, China is pissed off, but I mean, any one of us could have did it. Being in Hong Kong and seeing people come together, no matter what it is, it's kind of like inspiring sometimes, It wasn't like, oh man, screw China, it's, Hong Kong's. It wasn't, so derogatory where they were attacking China. It was just like, hey, but I get it. I get it why it's a big deal to China, why they're pissed off. But to the point that you're taking out on the whole entire NBA? Now, this won't really be a big deal if there are not a lot of people watching basketball in China, but there are a couple of people watching it to the tune of 800 million people in China watch the NBA. 800 million. Guys, there's 327 million people living in America. 800 million people watch basketball in China. That's how big it is there. It's huge. The NBA has a licensing deal with Tencent that runs, depending on who you're reading, anywhere from $500 to a few $1 billion. Also has a 30-year partnership with one of the biggest networks, CCTV, who broadcasts NBA games in China. But altogether, this partnership between the NBA and China, it's a multi-billion-dollar relationship when you account for everything. Media rights, streaming, merchandise sales, all this. It's a massive partnership that benefits everybody. So, of course, the NBA, Adam Silver, who's commissioner of the league, was in China a few weeks ago. He was in China a few weeks ago watching the World Cup basketball games in Beijing. They're trying to remedy the situation, which makes sense. They apologized, deleted a tweet from this, from the Houston Rocket executive. The NBA released how many statements? At least 20 so far. Trying to ease tensions. Okay, James Harden, who's the superstar, one of the best players in the NBA, who plays for Houston Rockets, issued an apology himself, saying how much he loves China. And Adam Silver came out personally and said, listen, I love China, but he also said, look, I support free speech, which he should, lives in America. But that further pissed off China. I mean, China was like, whoa, what? I mean, China's getting mad for something that we did, but yet they're kind of doing the same thing to us, right? But they got so pissed that CCTV announced, and this is on Tuesday, they would suspend the broadcasting of all NBA preseason games. Now, I have a question. What did China expect Adam Silver to say? That nobody in the NBA could tweet anymore? They could not exercise their right to free speech? Is that really what you wanted? I mean, let's put this in perspective, right? China being pissed at the U.S. for one person's opinion, and again, this person's not influential, it's not Donald Trump, it's not someone that's out there with millions and millions of people that people are going to talk about. Some guy nobody even heard of. But China being pissed at the U.S. for one person's opinion, talking about freedom, right, one of the virtues our country was founded on, it's like the U.S. being pissed at China after the general manager of the national ping pong team tweeted how much he loves AOC and believes the U.S. should be a socialist nation. And then after reading that tweet, our government instructs our media networks to ban ping pong from being watched everywhere in America. Really? That's the extreme? I mean, maybe not apples to apples comparison, but pretty close. Where I think we would just look at it and be like, oh, that person in China is an idiot. He doesn't understand our political systems. We wouldn't ban China from everything that, ping pong related. It's crazy. I mean, how sensitive are we? But this is the world we live in now. If this is truly what we believe, we should shut down all social media platforms. This way nobody's feelings would ever be hurt, because everybody has feelings now. Everybody has feelings. I'm offended you said that. I'm so offended. Everybody gets offended by everything now. It's so sad. But the situation gets even better. Because you know who started chiming in? Oh, wonderful politicians from both sides of the aisle, voicing their opinions. Two of them include Senator from New York, Minority Leader Chuck Schumer, and Senator Marco Rubio from Florida. So these guys are accusing the NBA, right, who's trying to remedy the situation with one of its biggest partners, of putting money over human rights, right? That's what politicians are saying. So they believe that the NBA, by apologizing for the comments made about Hong Kong and democracy, which, they should have did, they're now supporting communism. Are you kidding me? I mean, you have to love our politicians. I mean, these assholes are going to do anything to get attention with an election year coming up. First, Mr. Chuck Schumer, New York is a disaster. Families making $200,000 a year can't make ends meet. Home prices unaffordable. Traffic a complete joke. Airports are the worst, not just in a nation, but on the planet. Homelessness at an all-time record. The NYPD are now seen as the enemy. They get water thrown on their heads by civilians with cell phones, hoping to catch one of these police officers knocking the crap out of one of these idiots out on tape. Why? So they could send the tape to TMZ and become famous and then sue the police department for millions of dollars. Big Chuck, do me a favor. Why don't you focus on fixing New York first instead of complaining about a problem that doesn't concern you at all? I mean, come on. Our politicians are getting involved in this. Give me a break. And Marco Rubio. Dude, I live in Florida for 10 years now. You know, I know why the South fought a civil war to defend slavery. It's because most people here hate to work. They hate to work. They'll do anything not to work. And seriously, I have a pool in my backyard, which turned greenish after I hired some kid to clean it. And I actually didn't hire him. The person who used to do it was great for like 7-8 years. They sold a business, and you know the guy has his kid cleaning it who does a terrible job. You know, 5 minutes a week or whatever, but now the pool's terrible. So I called 3 different places to clean my pool. You know how many called me back? Again, I'm trying to give you business. You know how many called me back? 0. Not one of these people called me back, and I left 3 messages. And it's not an isolated example. I've cited dozens, if not hundreds of examples over the past 10 years I've been doing this podcast in Florida of how people hate to work here. And if you're from Florida, you're hearing this and you hate me, you know what I'm talking about because the people who work hard make a great living here. The people who are grinders make a fantastic living here. It's a great area. It's got a great tax structure. The weather's absolutely fantastic. But man, the culture is crazy. Also, the schools are horrible in Florida. The culture here is horrible, where it's okay for kids to be stupid and underachievers. It's perfectly okay. I mean, I saw this example with my kids. When my kids, great students, both, you know, A, B students, but over the past month or two, they failed maybe a test or two, you know, whatever, normal. And the teacher said, hey, you know what? You could take them over. What? You could take the test over? What planet do you live on? And what does that actually teach our kids? Not only that, you're taking up even more time. They could be learning a new topic because you're allowing them to take the test over in school. I told the teachers personally, listen, I don't want my kids taking their tests over. They have to live with their mistakes, make up the difference, get stronger grades on future tests in those classes. But you could take every test over? I mean, what is that showing? What lesson does that provide kids? That's right here. You know, you're looking at 6th grade and 3rd grade levels here. When I look at Florida, it's ranked one of the worst states when it comes to spending on education. They spend around $9,700 per student. That's from kindergarten through high school, well below the around $13,000 national average. There's a new report out saying Florida is one of the most dangerous states to live in. Think about that for a minute. More dangerous than Michigan, Detroit, right? Behind Maryland, which is home to Baltimore, New York, California. Holy cow. Rape and murder statistics are rising in Florida. Most school shootings take place in Florida. Hey, Marco, you know, do me a favor, buddy. Please focus on your own state before criticizing another country or business deal that doesn't concern you. Why are politicians getting involved in this situation at all? Come on, give me a break. It's like those people who have opinions on how you should raise your kids, right? Yet their kids are like on meth. They dropped out of school and ran away from home. Focus on your own damn kids instead of everyone else's, right? Everyone has an opinion about everybody, everything. And about the NBA apologizing. And guys, the NBA is a business. They generate billions and billions of dollars from the China market. If you're a business generating this amount of money from another country, communist, democratic, whatever, would you really tell them to go F off? Or, you know, for what? Just to gain some points with a few of our politicians? Especially ones that are doing a terrible, absolute terrible job in the states where they were elected? This is about business. And the NBA, just like every other company in the world, would do anything to keep one of its biggest partners. That's their growth market. But seriously, there's so many other things to get pissed off about if you're a politician trying to gain media attention. Talk about student loans. And don't go after Navient and the company making the loans. Have some balls and go after the schools who raise tuition like 10 times faster than the rate of inflation over the past 15 years. Why is nobody going after the colleges? Are you kidding me? They're the ones are they 100% responsible? No, but they're feeding into it. Oh, well, these guys are going to get loans for low rates, and they're just giving them $100,000, $200,000 loans. Hey, you know what? Let's just raise tuition and keep raising and raising and raising. No, you won't do that, though, will you? Nobody, no, you're not allowed. It's kind of like the housing crisis, right? We want to go after everybody, except the people who actually signed a loan where they're going to get a $600,000 loan and they make $30,000 a year, right? It's not that person's fault either. But let's get true. Have some balls. Go after the people who cause problems. There's so many things to talk about. Talk about abortion rights, trade, tariffs, immigration. Let's stay out of the NBA. They can do everything they can to salvage their relationship with China. It makes sense, and I really hope they do. I really hope they do. You know why? Because sports is the greatest thing in the world. And it's a place where all races come together and compete. When I played basketball, there's no racism. If you could play, you were on the court. If not, you weren't. It's peaceful, unless you're playing, soccer or football. Sometimes it gets a little crazy. It promotes teamwork. It keeps kids out of trouble. It's fun. It's a way for countries to bond together. And the most dumbest example, look, North Korea and Dennis Rodman. Why he was there, whatever. But if you watch the special and they had an inside look on that, you're seeing like the players taking pictures with the U.S. players and they're all hugging and they're hanging out. I mean, it's a way to bond where there's, to ease tensions when it comes to sports. Again, that was at a time when tensions were extremely high between North Korea and America. Americans were really pissed that Dennis Rodman went there. But when you see the whole backstory, you see all the guys come back, they were all thankful they did. They're like, wow, we met a lot of cool people. Not everybody's crazy and nuts, which is what we think, right? Because some people have different opinions. But again, as crazy as it sounds, it provided a platform for fun between two nations that were, close to going to war at the time. So I truly hope the NBA solves this, because it's going to be really sad if 800 million people in China are not going to be able to watch NBA games simply because one freaking person who nobody knew existed until a week ago sent out a pretty innocent tweet, again, who I disagree with it, but just supporting people who are fighting for something they believed in. And again, that's no disrespect to China. This is a serious problem. I know why you're pissed off. But it's not Trump tweeting. It's not Nancy Pelosi tweeting. It's not a popular NBA figure tweeting. It's just a random guy with an opinion who apologized right away and removed the tweet. So let's not blow it out of proportion here and get politicians about, get everything going crazy here. There's just too much at stake, including hundreds of millions of kids who just want to watch the NBA with dreams of maybe becoming the next Jeremy Lin or Yao Ming. You're really going to stop that because of a freaking tweet? Don't take that away from them. Definitely don't take that away from them. Anyway, a little bit of a rant there. Need a little bit of pause. Getting worked up, a little sweaty here. But let's move on, because I have an awesome interview set up for you today. It's with one of your favorites, who's John Petrides, who jumped ship and is now a portfolio manager at Tocqueville, a very prestigious money management firm with billions in assets under management. John is a great analyst. One of my guests I can go anywhere with, meaning we can discuss topics that are relevant in the media right now, which we're going to do, including the recent weakness in the U.S. economy, and can it continue to decouple itself from the rest of the world? The rest of the world seeing much more slower growth. The U.S. economy is seeing a little bit slow growth. Talk about what the Fed's going to do the rest of the year in terms of easing, especially at the latest round of data showing that things are kind of slowing. That manufacturing report is pretty scary. Talk about the current trade war with China. If there's a resolution before year end possible, we'll see. And as always, John will share some of his favorite stocks as we head into a really, really very uncertain earnings season, where earnings are expected to decline year over year for the S&P 500. So we're going to really dig into it. We provide lots of cool ideas, dividend-paying stocks, income stocks that I know you guys love. It's a really great interview coming up. And then in my educational segment, even though the markets are trading around 4% off their all-time highs, there's tons of names trading down 20 to 30% this year. And most of them happen to be small caps. As investors are lowering their risk exposure, right? You have so many uncertainties in the marketplace, political, global. I get it. But in this segment, it's going to be awesome. I'm going to show you how to find the best depressed names or ones that have the best opportunity of bouncing back. Because these are the names that could show you 30 to 50% returns in just a few months once sentiment turns from negative to positive again. Again, fantastic segment. Going to share a lot of names with you, dig into my methodology when it comes to finding the best depressed stocks with huge upside potential. Before we get to my educational segment, let's bring my buddy, John Petrides. Let's get to that interview right now. John Petrides, thanks so much for coming on the podcast, bud.
Hey, Frank. Thanks for having me on. Good to speak to you again.
Well, a lot of changes in your life, right? Maybe we should start there, actually. The recent job change. Why don't you tell everyone what you're doing these days?
Well, before we go to me, I was going to ask you the same thing about you. How you're feeling after the surgery?
I'm actually walking close to a light jog already. So
wow, that's good news.
Yeah, it is good news. So far, so good. And just got to strengthen up a little bit, a couple of months, and then I'll be back playing basketball. Hopefully, we'll see.
well, speedy recovery. We're wishing the best for you.
Thanks, brother.
Yeah, man. So I joined a new company, Tocqueville Asset Management. We have about $10 billion in assets, and I am on the wealth management team where we manage investments for individuals and families and institutions. Our team has about $1 billion in assets. And, one of our key strategies is our enhanced income strategy, where we're building portfolios for clients in retirement or institutions looking for yield, where we're getting about 4 to 5% in income based on, a variety of different asset classes, targeting 4 to 5%. So using individual stocks, bonds, preferred stocks, bank loans, emerging market debt, and it's been a great transition so far. I have reunited with my team from Bear Stearns over a decade ago, and Larry Fields, Heather Perlmutter, and Michael Meltzer, and Tocqueville's been a great place to be so far. So I appreciate you asking.
Congratulations, and I'm familiar with those guys. Fantastic, great reputation. Yep. So I know you're gonna kill it there. So all right, now let's have some fun. And I wanted to start off because you're one of the guests that we can go anywhere with. So let's go anywhere with it. Let's start off with the U.S. economy, which has been okay. Manufacturing was terrible, one of the worst readings since the credit crisis. Sentiment is low due to political global uncertainty, which is expected, but we're also seeing strength from the consumer in terms of spending. The housing market's catching a little bit. Unemployment remains near historic lows. So my question to you is can the U.S. economy stay relatively strong? If you want to say strong, it's not really that strong, but kind of strong in the wake of what we're seeing with the rest of the world, right? Or at least, most developed emerging economies that are actually seeing slow growth.
Mm-hmm. Yeah, I think it comes down to 2 points. One is how strong and how resilient can the U.S. consumer continue to be. The U.S. consumer is 70% of the U.S. GDP, and how aggressive and how accommodative will the Federal Reserve be? So the U.S. consumer is unemployment rate is low. The consumer is spending money. Maybe they're a bit more nervous given the volatility we've seen in the stock market, and just in general, more people's wealth is tied to what happens to the stock market. But by and large, the U.S. consumer is really healthy. They're not taking on nearly as much debt as they were, say, post the crisis. Home values are significantly higher. And by and large, the consumer spending. So as long as the consumer remains confident and comfortable, the U.S., I think, should avoid recession.
Now, on a scale of 1 to 10, how would you say how nervous investors are? Because for me, I feel like this is a very nervous environment where people are very worried. You're not seeing, it's not the typical Goldilocks. Some people are bullish, some people are bearish. It feels like most people are leaning bearish, which is a contrarian, is a good sign that maybe stocks go higher here. But, again, there's a lot of political uncertainty, things going on with China, the NBA now, all this nonsense. We'll get to earnings growth, which is going to slow to not even growing year over year. But how do you feel like investors are more nervous today than they've been in the past? At least I'm feeling that, but maybe it's just me.
No, I agree with you. I think, listen, the fourth quarter of 2018, which we're lapping here, was extremely volatile. I mean, the market dropped, 10 to 15% during that quarter, and that spooked a lot of investors who may have been caught flat-footed. So, and volatility by and large really has not subsided since then, but again, to the upside and downside. So I do think that by and large, the investment community is nervous. Wall Street analysts are baking in a negative 3.8% year-over-year decline in earnings, which will be the first decline in a couple of years, which doesn't feel good, right? That's never a good sign of earnings go down. You're seeing the macro data on the global front slow, if not contract, everywhere, every day. The uncertainty in trade wars with the tariff situation with the Chinese continues. You have a lot of people looking at the yield curve. The difference between a 2-year Treasury and a 10-year Treasury has been flat to inverted, to being upside down, meaning you can earn more on a 2-year bond than you can on a 10-year. Right now, it's positively sloped, but barely. So when that has been a negative slope, when a 2-year bond has yielded more than a 10-year, historically, that has been an indication of recession to come 15 to 18 months later. So, that happened over in August, and that spooked a lot of investors. Look, the last 2 weeks of September, I actually can't believe, Frank, how resilient the month of September was from the stock market standpoint. And if you look what happened the last 2 weeks of September, we had 5% of the world's oil production disrupted in Saudi Arabia, and I can't believe that hasn't spiraled into more geopolitical conflict in that region. The fact that has been relatively quiet is quite scary. We've had this issue with the president and the Ukrainians and the Democrats beating the drum on possible impeachment. We've had FedEx come out with a terrible earnings report and really citing global slowdown in the global economy, and you had this hiccup in the overnight lending market, the repo market, where the cost to borrow money for banks spiked to 8% overnight from 2.5% in like a 2-day period, where the Fed had to come in and pump liquidity into the banking system to allow for overnight lending. And yet the stock market finished up 1.8% for the month of September. So, I'm actually surprised that the market has been more resilient that it has been, given all of the uncertainty that's been going on globally.
No, it's good stuff there. And what are your thoughts on the Fed here, right? It's such a big topic where, I've argued that the Fed cutting rates to 1%, which is kind of what they said they're going to do, that's being priced in, has nothing to do with the economy or economic data, right? And again, I'm probably going by myself, but we almost have to lower rates to be more competitive globally. And, the rest of the world is easing. Every central bank's lowering rates. And, short-term rates are way, way too high when we compare them to corporate bond yields, even treasuries. Is there anything that would stop the Fed from lowering rates to 1%, maybe some crazy inflation number?
So, I thought the jobs number that we saw on Friday was possibly the best thing the Fed could have wanted. So the jobs number we printed a gain of 135,000 jobs. We have unemployment rate at 3.5%, but the key was wage growth dipped below 3%. Wage growth came at 2.9%. Now, when the Fed says that they're data dependent on their monetary policy, to me, wage growth has been the single factor that they've looked at to raising rates. So now with wages dipping below 3%, but unemployment staying at 3.5%, it's kind of like, to the Fed, that's great, because there's no pressure now for them not to cut rates, in my opinion. So I think because why would the Fed increase interest rates? Why do they keep interest rates high? It's to cut off inflation, right? You want to nip inflation in the bud before it gets out of control. And if you look back where we were over the last 10 years, we've been at historically low monetary policy. This has all been a huge experiment post the subprime crisis. And the Fed, there's many people fearful that the Fed has been printing money at uncontrollable levels, and we're going to see inflation spike like we did in the 1970s. Well, that hasn't happened at all. And now that the economy is slowing, the wage growth is slowing, it gives the Fed more dry powder to raise rates, definitely one cut before year end, but possibly two. And so I don't think it's relative to what other countries are doing, or I think there's room to run because the economy is just not growing nearly as fast as the Fed wants it to, and inflation just really is not an overriding issue.
Joe, with the Fed lowering rates, say if they go to 1%, is this priced into the market? Because this is a huge catalyst, right? And forget about your personal feelings, okay? We know this may blow up. We've been supposed to blow up since the 1970s. We've been talking about how dollar's going to collapse. We have too much debt. I mean, it's been an argument since the 1970s, and this S&P 500, it's the greatest secular trend, higher that you've ever seen. And I'm not saying that to slap anyone in the face or anything, but there's a lot of people worried, yet we have a decent economy here and, not terrible, not great, but not terrible. We're going to get to earnings in a minute here. But we also have the underlying factor where the Fed's going to continue to provide stimulus into this market, coupled with the fact that we know, and you know this, and you mentioned this to me plenty of times, look, Donald Trump, his economic indicators, S&P 500, every time it goes down, he announces something, I'm talking to China again. So it's almost like, you have all this, it's almost like putting a floor under the market here where when you do see sell-offs, it creates buying opportunities. Do you see that, or is the Fed kind of going to 1% already priced in?
I definitely do not think the Fed going to 1% is priced into the market yet. The Fed has consistently increased interest rates at 25 basis points at 1/4%, and now they're going step down to 25 basis points, 1/4% in those increments. So I think to get to 1%, you're looking at a 50 to 75 basis point cut in a relatively quick fashion. I don't think the bond market may be there with how much yields have compressed in the bond market, but the stock market is not there yet. There's some arguments out there, Frank, that the Fed is basically out of ammunition. That regardless of how low they lower rates, it's not going to help. That we're stuck in this sort of liquidity trap, similar to Japan, what Japan has been going through over the past 30 years. And I disagree with that. I mean, look what happened in September. You're seeing with interest rates going down, you've seen auto sales pick up because more people can borrow to get a car. 30-year fixed rate on a mortgage is 1 full percentage point lower than it was a year ago. The 30-year fixed was about 4.8 this time last year, and now it's 3.8. That has helped with housing. You had the largest amount of bond issuance in corporate America in quite some time in the month of September, as many many companies took advantage of the low cost of capital, the low interest rates, and refinanced the debt on their balance sheet. That's all good stuff, and that all of that is going to help with growing the economy, because one thing the Fed will never wants to see happen is deflation. The Fed will print money, and this is the mantra for global central banks. They will print money forever to avoid deflation. So the old adage is don't fight the Fed, and I think that's the case. And when interest rates go down, and when the Fed does try to stimulate the economy, it pushes investors out the risk curve, and stocks generally do good.
Yeah, and guys, look, John and I, we see it, we look at the data, and we tell it how it is. Like some people say, well, you're bullish on the market. You're not saying, we've been through this. I've been doing this for a long time, 25 years. You've been doing this for decades as well. Yep. But, you have to put your personal feelings aside, because it's very hard for the market to crash when you have a Fed that's willing to print money at will. Mm-hmm. That, again, nobody agrees with it, nobody likes it, but we're talking about your money here, right? So when you see things like this, it seems like even if we do come off and, a lot of the risks, manufacturing gets worse, or, political uncertainty, whatever it is, you name it, China trade, Euro trade, whatever, there's probably going to be a great buying opportunity. And one of the buying opportunities I'm seeing is actually small cap stocks, which got decimated, at least most of the Russell 2000. But we'll get to there in a minute, because we're going to talk. I wanted to ask you about earnings. Earnings season's here. Yep. Everyone is worried, right? According to FactSet, earnings for the S&P 500 expect to fall 4% this year over year. Other estimates around 3%, so 3 to 4% fall, right? So you're seeing earnings growth, but we did have, stimulus and just tax reform. So, we're coming off, it's called a bad comp compared to last year, but we are going to see a fall off. But more important, and I wanted to get your opinion on this, John, because you cover this great as well when it comes to earnings. Due to the uncertainties around trade with China and Europe, and also, politics, political uncertainty, just impeachment, whatever, I can't see companies. I mean, I could see them reporting earnings that are going to be estimates, because the institutions lowered earnings 3-4% on a whole going into the quarter, which you don't hear about, right? So they're probably going to beat the lower expectations. But do you see a lot of companies And this is what really drives earnings and drives the markets, raising guidance or issuing positive guidance or, not being conservative, given all these risks that we have and all these uncertainties in the market, that could really hurt us, right?
Yeah, I mean, I think when you look at building out a portfolio, right, not every company and not every industry is in the same growth trend. So that's the point of having a diversified portfolio, is that you're going to have some sectors that are just stronger than others and some that are weaker than others. And so, those companies where they're in a good secular growth trend upward and they're able to raise guidance in this environment, well, they're going to be rewarded handsomely. But I do agree with you that there's a lot of skepticism into what potential future earnings numbers can be. I mean, right now the market is expecting, I think, a negative 3.8% decline in earnings year over year. Now, listen, we have come off very high comps. I mean, the market was growing. The growth rates were very high year over year going back to 2017 and 2018, right? So to grow off of that number is challenging. So, but I do believe that dance will continue in that companies, more than 70% of the companies in the S&P will beat quarterly analyst estimates again. That has been the trend since March of 2010. But, guidance by and large has been brought down. And I think that's going to be the case. I can't see how, given the uncertainty, given the slowdown in the global macro environment, given structural issues regarding retailers and e-commerce, given how flat the yield curve is, how are banks going to do in that environment? There are so many issues given pricing pressures on pharma companies, from a political standpoint on drug prices. There's just so much happening out there that by and large, I'd be surprised if companies are on average able to increase estimates ahead of guidance or ahead of analyst estimates in the future. So that just means that forward estimates are going to be brought down, and at the end of the day, the market is a discount of future cash flows. But I would suspect that in coming earnings seasons, so next quarter, the quarter after, now you're lapping, negative growth rate earnings or 1% or 2% earnings growth. So the bar becomes easier to jump over in the out years. So a long-winded way of saying, if the Fed is cutting interest rates, inflation is low, and you have an easier bar to jump over, then next quarter could be better for earnings than today, and where possible you buy the dips. Does that make sense?
No, that actually makes sense. That makes a lot of sense. And so we're in agreement. It's going to be really hard for these companies to actually issue, positive guidance going forward with so much uncertainty, especially those that have exposure to the global markets. Because again, Europe, China. I mean, you look at, say, if you're a semiconductor company, just some of these names that have gotten blacklisted now. I mean, that could account for a big percentage of their revenue, where companies are saying, well, Marvell is probably not going to make their estimates because they're leveraged to one or two of these companies. So it's very hard to actually go out there. But I guess what I'll ask you is a lot of this priced in, because I haven't seen anyone that's really excited about earnings season. So our expectations so low, and that's the game, guys, right? It's all about expectations. Expectations are high. Even when you beat, you can see a stock fall. And when expectations low, they can miss estimates, but, report less than bad quarter, and you'll see a stock pop 10, 15%. So, when I'm looking at expectations, I don't think I've seen them this low heading into earnings season. I wonder if a lot of this is priced in, which, again, we'll find out, right?
I agree with you, and the fact that the stock market is only 5% off recent highs or whatever it is really interesting, because there is, I would call it, a very healthy sense of pessimism. Listen, when everyone thinks things are going well and the economy is going strong, that's when bubbles get formed. Go back to 1999, pets.com, .com could do no wrong, and it inflated the stock market and inflated the tech sector, and look how that ended up. Then we went into the housing market, and the story was, well, you could never lose, the U.S. housing market hasn't gone down to the Great Depression, you can't lose money in real estate. Well, how did that play out? Right now, find me where there's overly optimistic in publicly traded markets where there's so much optimism, where valuations are out of whack. It's hard to find. In the private sector and private equity, where because the cost to borrow money is so low, and because there is a lot of cash being sloshed around, valuations in the private sector are quite elevated. And you're seeing, look at these tech unicorns that have come to the market. These once privately traded, these private companies like Uber and Lyft, and look what's happened with WeWork and all of these other companies that have now come to market. They've all gotten destroyed when they've hit the public market, because on the private side, so much cash has been looking for a place to park money because you can't earn it. You can't earn it, and it's harder to find returns in other places, that the valuations got too high once they hit the public markets. So having some skepticism has held back valuation, which it's maybe counterintuitive, is actually a good thing for investors in the long run.
No, it definitely makes sense. Okay, now for the fun part, which everybody loves when you spout a bunch of ideas. I always ask you, hey, what are you looking at? And you send a note saying, look, this current environment, it's great for high dividend paying stocks, favoring those companies, not just for high dividends, but you specifically said high dividends, low payout ratio, strong balance sheets with a good history of growing dividends. Why do you like this area of the market? Is it simply because interest rates are going lower, it's harder to find income? And what are some of the names that you actually like, since it's a pretty big pool of what you talk about?
Yeah, I really think, Frank, that we're in the golden era of high yield, low beta stocks. I mean, think about, if you take a step back from all the noise, whether it's political, China, whatever it is. Here's the fact. Right now, $14 trillion of bonds in the global bond market have a negative yield. That means people are buying bonds where they're going to lose money. That's unbelievable. That's how low interest rates have come down. And then on the other side, the stock market volatility has picked up a lot. And although I do think stocks are the best asset class relative to bonds and cash right now, although I do think people should be diversified, there's a lot of uncertainty in the stock market. I mean, I could argue the case bull and or bear for stocks over the next 12 to 24 months. So I think because interest, and with global central banks basically reigniting QE, quantitative easing, printing money forever, you're seeing that in the European markets, you're seeing it in the Chinese market, you're seeing it now in the U.S. market with the Federal Reserve lowering rates. Investors are going to be craving for yield. They need it. If you're in retirement, you want some income to live off your portfolio because you're not working anymore. So I think high dividend paying stocks and high yielding stocks are going to continue to do well. Now, on the flip side of that, you don't want volatility. I mean, investors, particularly those that are in retirement or those that are institutions where they have a certain mandate for their returns, they can't handle the volatility. So low volatile stocks are going to be in vogue again, or will continue to be in vogue. They're continuing to be popular. That's what we like about our enhanced income strategy, because we're targeting this 4 to 5% type of yield using multiple asset classes like high dividend paying stocks, which I'll go to in a second, preferred stocks, bonds, emerging market debt, bank loans, MLPs, REITs. The combination of all these assets, we're able to get this higher, above average yield in a lower than S&P volatile way. So two stocks that I like. One is Plains Group All American. PAGP is the ticker. And Frank, what I like about this is that it's an oil and gas pipeline. Now, remember, the MLPs, the Master Limited Partnerships, they got destroyed in 2018, 2014, 15, and 16, and they really haven't come back. The story on the MLPs were that, this group was, not susceptible to fluctuations in the price of oil. They were toll roads. Well, that story really proved false, as many of these companies with the price of oil collapsing had to go hat in hand to negotiate their contracts lower. Well, what I like about Plains Group is, PAGP is not an MLP. It's not a limited partnership where you get a K1. Okay, so from a tax standpoint, it's so much more beneficial. You can own it in your IRA. You can own it in your taxable account without getting a K1. 2, you're getting a 6.2% dividend yield. So really high yield. 3, it's one of the best relative to its peers in terms of the quality of its balance sheet. It is one of the lower level leveraged balance sheets, not that much debt relative to its income. It has an 8% growth rate over the next couple of years on its dividend. it has one of the higher coverage ratios on its dividend relative to its peers. And by the way, the energy sector, I think, has sold off a lot. So I do believe that energy, by and large, is an attractive sector. So that, I think, is a really good holding that we own for our client portfolios, PAGP. The other one is Watsco. Ticker is WSO. This is an industrial company, and Watsco is a distributor of HVAC systems, so heating, air conditioning, and cooling. The market is about $35 billion for the HVAC market, and Watsco controls about 12% of that. They're the largest player in the space by far. It's only it's a $6.5 billion company. They have about $4.5 billion of sales, and basically the way they've been growing is through acquisition. They've been going into larger markets, buying up smaller, mom and pop HVAC distributors, and basically leaving them alone. They take out all the synergies on the back end by providing better sales support, better technology, better billing, things like that, and they leave the brand of the local mom and pop on their own. Why do I like this stock? I think there's tremendous amount of runway. As more people migrate to the southern parts of the states, you're going to have more HVAC systems in use. The company has a 3.9% dividend yield, of which they've grown a little bit over 20% annually over the last 3 years. They've grown their dividend 20% annually over the last 3 years. They basically have no debt on their balance sheet. So why such a favorable dividend policy? They have if you're an employee of Watsco and one of the executives, their business policy is you work for the company and you get paid in stock, but you can't vest the stock until you're 62 years of age. Right? If you leave the company, if you get fired or whatever, you lose all of your stock. Right, so it provides for senior executives significantly large incentive to stay with the company, and basically management pays themselves through the big dividend. So management is on your side, on shareholders' side, to continue to pay out and grow the dividend. They've never had a balance sheet a debt leverage of more than 1 times net debt to EBITDA. So they don't like taking on leverage. And here's the kicker, too, Frank, that I really like, and why, from a business standpoint, why I think Watsco is really interesting. They own 80% of Carrier Enterprises. So Carrier is the air conditioning unit out of UTX, United Technologies, and Watsco owns 80% of that entity. So they're vertically integrated through one of the best carriers, one of the best HVAC systems in the world from a technology standpoint in terms of Carrier. So you have a tremendous amount of runway to go from a market share standpoint. You have a 3.9% dividend, of which a management has grown that dividend forever. The management has aligned themselves along with shareholders to drive shareholder return. So, in the short term, there's some volatility with this stock and with this company because there's always an argument as to what inning are we in terms of the HVAC replacement cycle, because it's not necessarily new houses with new air conditioning units that's driving growth here. It's, all those homes that are in, Arizona, Las Vegas, Nevada, and Florida. When their HVAC breaks, these guys come out and fix it. So Watsco is a really interesting company and one of the holdings that we own in our enhanced income strategy and type of holdings that we own.
Yeah, no, 2 fantastic names, and anyone who lives in the South is very familiar with HVAC systems.
Right, exactly.
Yes.
and Frank, when it's 116 degrees in Arizona in August, you're not waiting around to call somebody if your HVAC breaks, right? So you're on the phone with these guys right away, and you need someone there instantaneously. So Watsco has done a great job from a technology standpoint where they've built out apps on their phone for all their distributors where they can get orders and they can get the replacement parts to their distribution centers really within a 1 to 3 day type period. So their customer service is where they're picking up a lot of market share as well. So, we think that's an interesting holding. Now, listen, from a valuation standpoint, it is definitely not the cheapest stock out there. It is trading at about 23 times forward earnings. That is a premium to the market. But you going back to, the theory on where we're finding income, where's a management team that's looking to grow that income, where's a company where the balance sheet is very healthy, this fits the bill for us.
Nah, it's great stuff. Okay, a couple more questions here. Run out of time, and this is probably the most important question I'm going to ask you out of all of them is, how's your fantasy football team doing this year?
All right, so thank God I'm co-managing my 4 leagues with my 12-year-old son, because he's done a great job. We're 4-1 in one league, 3-2 in 2 others, and then 1-4 in the last week that we're sucking some wind on. So by and large, we're doing okay. The fantasy gods helped me on Monday Night Football's game. I was down by 10 points going into the game. I had George Kittle, the tight end, and he had Robbie Gould, the kicker. And thankfully, the kicker missed 2 field goals. So I wound up winning by 2 points. So the fantasy gods smiled down upon me for once to keep the season alive.
It's so funny because if you're not in fantasy, you're like, oh, and if you're on fantasy, you know exactly what you're talking about.
Yeah, exactly. And yourself?
2 leagues, and one of them I am 4-1, and the other one I'm 2-3, just won this week. But the one I was 2-3, I was 1-3. Listen to this, leading the league in points, and I was almost 0-4 because I literally played. I came in second in points almost every single week, having the second highest score. I just happened to play for the best team every week, but a lot of teams make the playoffs, so I'm going to be fine in that. But doing okay in both of them, and yeah, I love it. I enjoy it. I've been doing it for over 20 years, so it's really cool. So I guess, John, we'll end with this. If anyone wants to learn more about you, you're a new place, how can they do that?
I appreciate that. So I'm at Tocqueville.com, Tocqueville Asset Management, TOCQUEVILLE. My email is jpetrides@Tocqueville.com, and you can find me on Twitter at jpetrides2. I have a new Twitter address, so at jpetrides2.
All right, great stuff, John. As always, love having you on here. We go everywhere, talk about everything. You always share ideas, and that's why people love you. So I really appreciate you coming on, buddy.
Thanks, Frank. Really appreciate it.
All right, talk soon. As always, great stuff from John. Love hearing his thoughts about the economy. He's all over TV still. I love the fact that he's working for such a great firm. I really like Tocqueville. Good guys. Great company, and been around for a while. So, I'm really happy for him. And he loves coming on here. I was worried because sometimes there's, firms that are really, it comes to their compliance department. We started with Stephanie Link, who would love to come back on the show, but sometimes it's a little difficult. I'm glad he can still come on and be a regular because he always provides great stock picks. But I say this all the time, the podcast is about you, not about me. So let me know what you thought about that interview by emailing me at frankcurzioresearch.com. That's frank@curzioresearch.com. Now let's get to my educational segment, which is about finding the best depressed stocks, right? And there's a lot of them. Let me tell you something. I ran a screen on yesterday, the Russell 2000. And I was focused on names that were down 20, 25%, 30% off their highs. Okay, we're talking about 2,000 names, small caps on the Russell 2000 index, and you're not going to believe what I found. I mean, I didn't believe it, but close to 30% of the index, right, the companies in the Russell are down more than 15% year to date. That's kind of crazy when we're trading 4% off all-time highs. And again, that's the major indices, right? So let's focus on Russell. And what's even crazier is 25% of the index is down 20% or more. So 25% of the names. It's a lot of names. So there's a reason why, if you have small caps in your portfolio, that you're seeing them pull back, and a lot of them are down a little news. Just, overall selling of the Russell or risk-off trade. But I'm talking about popular names that I came across. I'm sure you heard of some of these names. I'm going to run them by you. I know that you love it. What I would give you as many names as possible. Here we go. Hecla Mining, Redline Hotels, EW Scripps, AMC Entertainment, PedMed Express, Uranium Energy, Neighbors Industries, Ligand Pharmaceuticals, with a few royalty specialty companies in the pharmaceutical space, American Eagle Outfitters, Movado Group, Tanger Factory Outlets, iRobot, MSG Network, Netgear, Callum Petroleum, Golar, LNG, Spirit Airlines. Spirit is down over 40% from its highs this year. Tupperware brands down 50% from its highs this year. Stamps.com, Cars.com down 55% from its highs this year. And then you have companies like McDermott down 70%. I don't know if you heard of all those names, but I bet you heard of quite a few. Now, how do you find which names are worth buying? Because you don't want to try to catch a falling knife, right? You just want to try to find the diamonds in the rough, because when these things turn around, you can see massive, massive gains because they're so depressed. So one of the first things I look at when I go hunting for depressed stocks is the industry they operate in. In other words, is the industry that these companies work through, operate in, are they growth industries? They operate maybe in cosmetics, cloud, big data analytics, connectivity, digital advertising, biotech, which I like specifically with biotech, is immunotherapy, gene editing, DNA analytics, all growth markets. Healthcare, which is a massive growth industry, and so many names have come off their highs, mostly because of the political uncertainty, where some candidates have pretty crazy plans that they're going to make drastic changes to the healthcare plans, right? So there's a lot of uncertainty there, which is providing an opportunity. Industries that I'm kind of skeptical about: oil drilling, oil services, retail, not all retail. There's some retail companies doing perfectly fine, but specifically those leveraged to apparel. Gambling industry, actually little growth you're seeing in this industry. In terms of the casino front, see a little bit of growth in sports betting after, legal changes, Supreme Court ruling, online gambling. So not everywhere, but, the casino front, not too crazy about. Commodities in general, which are highly leveraged to manufacturing, where U.S. manufacturing hit its lowest level since September 2009. So the reason why companies like McDermott, Fluor is a bigger company, U.S. Concrete, have gotten smashed along with most copper companies. So some of the names that I looked at, let's take a name like Spirit. They are highly leveraged to Boeing, since most of their fleet are MAX planes, which they're having trouble getting off the ground. But I see this as a temporary headwind. Eventually, this is going to be solved. It's taking a lot longer than expected, and that's fine. But I would look at Spirit. I would look at their valuation. If it's attractive, I want to look at, catalysts that would move the stock over the next 3 to 6 months. That's important, because cheap names will get cheaper if they have zero short-term catalysts. That's why it's not easy buying uranium here. There's no real short-term catalyst in uranium. People could argue 3, 6 months from now, demand's exceeding supply, but there's no urgency there. And when you really have no catalyst in the market, they're going to punish you. You get punished if a company says, oh, this quarter, we're pushing out, a lot of our contracts got pushed out to the following quarter, and these companies solve 25%. They don't even care. It's just a 3-month lag. They don't even want to hear it. Even if companies are expected to generate, $2 in earnings and they maintain that figure, but, lowered their earnings, report a weaker than expected earnings because a lot of those contracts didn't hit this quarter. They're going to hit next quarter. And you'll see a company like that still have 25%. So the market just, when it comes to time and that factor, 3 months they hate, but you want to find companies that have short-term catalysts. And most important is I want to know if insiders are buying. And this is where insider buying is extremely relevant, because if a stock is down 30% plus and management's not buying, then why the hell should I? Why the hell should you? And real quick, guys, when I talk about insider buying, I'm not talking about 10% owners and hedge funds. That's okay. That's a good sign. Don't get me wrong. But a stronger sign is when you're seeing the CEOs, the CFOs, management, upper tier management buying shares aggressively that already have big positions. That's a big buy signal. That's one of the reasons why I like Ford. $8 million purchase when the stock fell off its highs. That's showing a lot of conviction despite everything you hear about Ford and why the stock should be sold tremendously. I covered that in Frankly Speaking last week. I would look at a company like Tanger Factory Outlets. Yes, this is retail, but outlets are pretty crowded. These areas have low vacancy rates, especially on the outlets that focus on high-end luxury stores, crowded all the time. I know this probably pays a high yield because I believe it's a REIT. And that high yield, I'm figuring in because the stock is down so much, but I'm looking to see if the yield could be sustained. And maybe it won't. And maybe I'm looking at a company that has to suspend the yield, which is not the worst thing, suspending your yield to save cash, to improve your balance sheet. However, there's income funds invested in these high dividend paying securities that, their mandates are, if they cut the dividend, you got to run. And you'll see these companies fall 10, 15%, even further than they already come down. And maybe you want to wait for that, because that could provide an amazing opportunity for you to buy at a really rock bottom price. because it's going to be forced selling. MSG Networks, right? That's MSGN, which owns MSG Network and MSG Plus. It's different from Madison Square Garden, which is MSG, which owns and operates professional sports franchises. But same thing here. Are insiders buying with the stock down so much? And why is it down so much? I mean, Yankees are on fire right now. The rest of their games are going to be broadcast on national television for the playoffs. But this team's intact. They're going to be great for a long time. You can see tremendous viewership. They'll increase next year. Again, the Yankees are here. They're good. They're a good team. I hate to say that being a Mets fan. That's despite the Knicks having a terrible offseason, signing basically none of the superstar free agents that were on the market. But still, it's a stock worth looking at. Media, a lot of media companies have been beaten up. Now, I'm going to be honest with you. I don't know if any of these are buys. I'm just giving you examples here. After my research, I may say, hey, guys, remember Tangier, remember MSG Networks and Spirit? They're all shorts. I don't know. But it's a starting point. And this is part of my research and methodology that you don't see as subscribers, right? All you really see is the pick I'm actually recommending. But the work leading up to that pick, it's a big process. I'm probably analyzing 20, 25 companies for choosing one name. And this process is important because if you find a depressed name with numerous short-term catalysts where insiders are buying, this is a name that could easily pop 25% in a few weeks. All you need is just a decent earnings report or one that shows that things are not getting worse. I mean, stock's down 30%. A lot of it's factored in that they're not expecting too much out of the quarter. Probably not going to get too much high unless they really, really bomb the quarter. But if they report inline estimates, this thing's going to pop 10, 15% right away. And if they happen to see a turnaround, this stock's really going to take off and you're going to be in at such a great price. And then you know what happens. Stock goes from 10 to 13, 14, 15, and you're up 40%. And all technical analysts are like, now you got to buy. And it goes to 17, 18, 19, and you own it at 10. It's pretty cool. I'm not telling you to sell your conservative holdings like staples, utilities. These are sectors that are doing very well despite having little growth because investors flock to these areas in the market for safety, right? And there's a lot of uncertainty out there. But when it comes to your speculative money, this is the area you want to research, which is small cap names down more than, you could say 15%, but there's plenty that are down more than 20% of the year, 25% of the index, a lot of stocks. Because a lot of these names are down mostly because of the overall weakness in the Russell 2000. Again, risk-off environment, not because anything is fundamentally wrong with these companies. And you'll find a couple of them that offer tremendous opportunities, again, if you're a speculative investor. So this is what I'm doing right now. It's what I always do at Curzio Venture Opportunities, finding hidden gems at super depressed prices that have short-term catalysts, also have insider buying, and operate in a secular growth industry. Okay, hopefully you got all that. Wasn't too much for you. But again, I'd like to take you behind the scenes of how I'm researching stocks, something that you don't see where, you just see the stock pick and everything in 12-page report and details. Well, Curzio Venture Opportunities, also Curzio Research Advisory. But there's so much that goes into it that I'd love to teach you. And hopefully I touch a little bit there about how to find some of the hidden gems in the market. And the best place to look right now is the Russell 2000. That has really, really, really underperformed the overall market. Okay, guys, quick note here before I go. So getting a lot of emails on this now that I covered it last week. Our Dollar Stock Club newsletter, it's live. It's here. So learn more about how to get a stock pick a week from some of the leading experts on Wall Street for just $1. It's no joke, no BS. You can cancel anytime. Just go to www.mydollarstockclub.com. And it's a super low price newsletter. It's going to give you a ton of new ideas and from the experts I interview on Wall Street Unplugged, this podcast, guys like John Petrides. Some of them come from names that they mention and a lot on the podcast, and you'll see names that they didn't mention on the podcast because I talked to these guys before and after the interview too. Discuss some of our favorite ideas and catch up. And these ideas are really cool, guys. I'm not talking about just large cap conservative. No, they range from international ETFs, cryptocurrencies, gold plays, biotech, small cap tech, shorts, income names, safe haven plays. So no limitations on these ideas. And trust me, most are original or names they elect. I never heard before. It's a really cool product. You definitely won't find another newsletter like this anyplace in the industry. So if you're interested, again, want to learn more, just go to www.mydollarstockclub.com. If you're not interested in getting a new pick every single week, delivered to your mailbox for just $1, no worries. Just trying to offer you a low-price product, a lot of you ask for, where you don't have to pay thousands of dollars or have millions of dollars in a hedge fund to invest alongside, some of the smartest stock analysts in the world. So guys, that's it for me. Thanks so much for listening. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.